Good evening, everyone. Welcome to our MQ Trader webinar tonight. I'm Casey from MQ Trader and the host for today's event. Today, we'll be discussing on whether Singapore is a safe haven for investment, and if yes, why is it so? So before I continue, can I have a quick mic check? Please type 1 in the chat box if you can hear me clearly. Max, thank you for your response. Hafiz, okay. Okay, so I believe most of you can hear me clearly. I think all of you can hear me clearly. Thank you for your response. So let me start with a brief introduction to MQ Trader. MQ Trader stands for Malaysia Quantitative Trader Group. We collect quantitative data, which is only available to large financial institutions. And we use this data to develop our MQ Trader stock analysis tool. And we've made it available for our MQ member for free. And with this tool, we seek to empower our members to make quicker decisions and with greater confidence. And just to let you know about MQ Trader system, other than our MQ Trader stock analysis tool, we have the MQ E-Trade, MQ Points Accumulation, MQ Affiliate Program, and many, many more. So to enjoy free access to all these MQ system, you just need to open a trading account with our selected advertiser here, which is M Equities LYH team. So if you're interested, you can scan the QR code and submit your details on it. And here's a showcase on our MQ E-Trade. This is a system where you can view a lot of information about a counter at a glance. So the information include live market updates, live market quotes, exclusive MQ trading signals, and also 10 market depths, up to 10 market depths. And here is our MQ Trader stock analysis tool. You can get buy and sell signals with just one click. You can also even do back tests by just clicking the button here, and then you can test the past accuracy of the signals itself. And once again, coming back to our MQ Trader system, I just want to highlight that for today only, you can get extra 500 MQ points when you open a trading account with M Equities LYH team. So if you're interested, please type 3 in the chat box, or you can submit your contact details through the link. It is considered as from this webinar, and you will get the extra 500 MQ points. And the respective team will guide you on the next step after this. And what's more, M Equities LYH team also have this 100 ringgit cashback campaign where you can get 100 ringgit cashback if you open a free trading account with them, plus you have 3 buy transactions on Singapore market. Any Singapore stocks also can. So the campaign ends in 31st of December this year. So if you're interested, please scan the QR code or type 3 in the chat box to let us know, and the respective team will contact you shortly. Okay, so a quick updates from MQ Trader. We have released our MQ Trader calendar for year 2023 in our marketplace. So you can visit the marketplace and redeem yours with your MQ points. And based on previous record, our calendar is always a hot selling item. So if you're interested, remember to scan the QR code and place your order as soon as possible. Next up, for our MQ members, you can get a bonus 300 MQ points as check-in rewards. You just need to screenshot any part of this webinar and then submit it in the quiz after that. We will be sending it after the webinar. So you can find a quiz after the webinar in your email itself. So if you want to take a screenshot, you can take it now. I will pause a few seconds for you to do so that you won't forget about it. Okay. Right, if you want to receive our post-webinar updates, including the quiz and also the recordings, you just need to register here. If you haven't registered, remember to register now so that you can get our post-webinar updates. So I'll pause here again for you to register, anyone who wants to register for the post-webinar updates. So while waiting for them, a gentle reminder, you need a screenshot of today's webinar to claim your check-in rewards. So if you haven't taken a screenshot, you can take it now as well. Okay, we will be having a Q&A session later, so please feel free to send us your inquiries throughout the webinar. And right after the Q&A, before the webinar ends, we will have a mysterious gift session. So we'll be giving out gifts worth up to 249 ringgit. So make sure you stay till the end so that you can have a chance to get the gifts. Moving on to our topic today, our speaker will be sharing his view on few major indexes and also why he thinks that SGX is one of the best markets to invest now, and how Singapore currency and interest rate will affect us when we invest in the Singapore market. And our speaker today, Max, he is a managing director of 12 Invest. He has accumulated over 6 years of experience in debt consultants, and then he holds of multiple roles in Rakuten Trade and also TA Securities. He has spoken in Sinchu, SGX Academy, Bursa Young Investor Club, and many, many more. So are you guys ready for him to start sharing now? Can you type ready in the chat box to let me know you're ready? One, Zulkarnain, you're the first one. Thank you. Just one ready? Jiajin ready? Yeah, there are many, many more. Thank you. I think you guys are really ready now. So I would like to invite Max to share with us now. Max, I'll pass the time to you.
Okay, thank you so much for being such a good host, and thank you for the response, everyone. Just to do a quick mic test, if you can hear me, can you you could raise your hand or you could say a hi. Vicky, hi. Good evening. Hi. Okay, great. I think there's no problem on the mic. Also, let me share my screen and let's start the sharing today. So we'll be sharing mainly on is Singapore's safe haven for investment now, especially in the difficult times for now. I'm sure that we all experience quite a hit, or if you haven't started investing in the market now, I think it's quite fortunate timing. Now it's a great timing for you to start investing. But if you're in the market like me, probably you have taken a hit in your portfolio due to the global uncertainty. So let's have a study together on whether Singapore is a safe haven for our investment. Okay. But before that, let me do a very quick disclaimer on what we are going to share today. So all the views and opinions expressed, blah, 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 basically, whatever we share today, they are not any kind of buy or sell advice. It is only my sole opinion and my own research. So I strongly recommend you to consult your own financial advisor or investment analyst before you make any kind of investment decision, right? Okay, so first topic we have here is the interest rate versus inflation. Now, I'm sure that every one of you have experienced a more steep inflation issue now. Now, CPI data in US actually shows that in October, the price or CPI has actually increased by 7.7% previously, which was quite steep in my opinion. Then this data is actually followed by 9.1% in June 2022, 8.5% in July 2022, 8.3% in August 2022, 8.2% in September 2022. In fact, the CPI has been dropping. So it has proven that the Fed decision to increase the interest rate is actually quite useful, to say the least. But it what cost? If you think of the longer term impact of the interest rate increase, eventually it will come back to haunt all the businesses and also individuals who have a high debt profile. So, but anyway, for now, interest rate hike is definitely working for US. So, in fact, now we are seeing that this is actually a general all items in the city, the index, particularly we can see that actually the increase most significantly we are seeing on the fuel, oil, basically as you know, the low base in 2021, we are seeing a larger rebound impact, especially on airline fares, fuel, grocery, restaurant, and it's basically a more towards a low base fare on the first two items. But anyhow, the energy prices has indeed gone up by a lot. Now, what does energy prices gone up have to do with us? If you're in Malaysia, then you are fortunate enough, you're not too impacted by the energy prices because our petrol is quite subsidized. But for businesses that they are using or consuming a lot of energy, for example, the manufacturing line, if you have a direct hit on their bottom line, which means their profit will be significantly affected, especially in manufacturing. Typically 17 to 25% of their cost comes from the energy segment. So you can see that a lot of manufacturers there has been talking about energy cost increase has been affecting them. Now, in Bursa Malaysia, we have quite a number of traditional stocks that are in the manufacturing line. So you might want to be careful when you're investing into the manufacturers, especially in the heavy industrial, which they consume a lot of energy. So this is what you should take note on top of the inflation and interest rate impact that we're seeing. Okay, so now we are actually in an environment where this is the 6th consecutive rate hike by the Federal Reserve, and 4 of them are 75 basis points. So this is quite steep, as you can see. As you can see here, the rate hike has been quite steep, where the 4 times of 75 basis point hike is quite it's quite major. Okay, so this is actually the highest borrowing cost for the US market since 2008, which is the subprime crisis, right? So now with inflation and interest rate in mind, apart from affecting our cost of borrowing, of course, if you have flexible loan, the OPR increase, or you're in Singapore, your base rate increase, it will definitely affect your repayment. But more importantly, with inflation in mind, your real rate of return has also been affected. So what do I mean by real rate of return? So assuming that you're generating a 10% return in the equity market, but then you are hit by 6% inflation. So your wealth in real gain, so-called real gain technical term, you only get 4% return, in fact. So it is more important now for us to diversify our assets to safer places where we could fight against the inflation, at least to not lose out. Even if you put your money in bank, Malaysia, I think Maybank is offering about 3.3%. It's definitely not sufficient for you to fight against the inflation in Malaysia. So official data shows that we are in 3% plus minus, but obviously that is not the real inflation rate that have reflected a lot of items. So if you go out and dine, I'm sure that you already feel the impact now. Okay. So okay, so there's also a lot of factor that affects which we'll talk about, which is the political uncertainty that's happening around the globe. I would also like to touch a bit on the forex exposure. Now, if you're in Malaysia, I'm sure that you note that Ringgit Malaysia, due to several factors, it had been depreciated for quite a bit. If you look at the Ringgit, the highest that USD against Ringgit Malaysia, we went up to 4.7, 4.8, which is quite substantial. And in terms of our real consumption power in the market, as inflation goes, again, your buying power diminishes. So it's important for you to have a multi-currency portfolio for you to diversify the risk. Now, I will show you on the currency performance of US dollar, Sing dollar, and also Malaysian ringgit later on, so you can see the difference in between the few. Okay, so next up, we'll talk a bit about the political uncertainty, which are some of the key things that you should take note. But I'm sure you already have taken note of. This is the unfortunate remainings of the Russia-Ukraine war. So apart from the COVID-19 that has caused the supply chain disruption, and there's a bit of backstory to the hike in energy prices. So particularly on the gases. So take Europe as example. So many years ago, actually, Europe, they take a lot of gases as their main source of energy from Russia. So there's a statistic show that Europe actually take Russia, Norway, Algeria, their source of gas up to 80% of the contribution. So you can imagine once they have the curb, or once they have this cut off from the supply of Russia, how bad it will impact on their country itself. Okay, so since the war commenced in 2022 February, we've seen a lot of conflict in supply and demand. Some countries in Europe, they refuse to actually complete settlement in ruble, Russian ruble. So it also causes a lot of supply chain disruption as well. So another thing that we see from Ukraine is they supply quite some key material in the semiconductor industry, which is the neon gas as well. That has also impacted the value chain. So you might think, how does this impact my portfolio or my return? So if you look at the performance of the technology stock now, reflecting the past third quarter, if you don't talk about financial year, we talk about calendar year, which is reflecting mostly the results are on July, August, and September, you will note that there is a slowdown in terms of growth, or there's a decline in terms of growth due to, especially on the smartphone or smart devices industry, where some of the companies that touches the industry, it actually got affected quite badly due to the slowdown in demand. So plus the supply glut that we are seeing, the lower lead time delivery, and also the demand curve. So you have to be careful when you still have technology stocks in your portfolio. Okay, so we'll talk a bit about diversifying your portfolio into Singapore banking industry and also REIT industry afterwards. Okay. So another thing that is happening that I feel that the market does not emphasize it enough is the deglobalization. Now, deglobalization has been happening quietly. I think it started back in 2018, where the first trade war was initiated. Donald Trump actually says that the Europe has been relying on Russia too much in terms of the gas supply, but of course, back in the times, no one is actually listening to him. But we can see how ironic it is when the Europe is actually crying for gases now. So looking back at the political uncertainty when Donald Trump got up on the position, obviously he's tackling against China. So why is he so afraid of China? It's because if you look at the global chip manufacturing market share, you have US, when we talk about the geographical, we're not talking about US company that have expanded into countries like China, countries like Asia, countries like Malaysia, especially in Penang, and some of the companies that are in Singapore. So we're not talking about that. We're talking about geographically in US itself, the global chip manufacturing market share has actually dropped from 37% to 12% since 1990 to 2021. So it's obvious that the US, they want more control in terms of the export of chips against US to China. So there's another new, what we call, curve that is out to prevent the export of high-end chips to China for military purposes. So yeah, we are seeing more and more political uncertainty. That's another hit onto the global supply chain once again. So if you are investing into technology stock or manufacturing stock, you might notice that there might be a more severe supply issue. Then coupled with the slowdown in demand, again, it's a double impact in terms of the earnings of that company. Okay. Now, unfortunately in Malaysia, that we just had our general GE. There again, as expected by many, we have a hang parliament again. Until today, there's no result on who will be the prime minister. So if your portfolio is solely in Malaysia, you might face a de-rating that might happen in Malaysia when the foreign funds, they are moving out from Malaysia due to the political uncertainty. So this is one of the things that we should take note. Unfortunately, I think political wise, Singapore, they have a slight more stable stance in as compared to Malaysia. I think that proves that in their currency, how the currency perform over the time. Okay. So obviously we will also have the foreign exchange risk. Now, if you are in Malaysia and obviously there's a risk of diminishing due to the fact that OPR, they are not increasing the rate as aggressive as to US. But come to think of it, if Bank Negara actually increased the OPR as aggressive as US, I think definitely it will be more severe impact to the Malaysian, especially when a lot of borrowings in terms of the property market, we are taking flexi loan. So when the OPR goes up, naturally, now the banks in Malaysia, we are using SPR, standardized base rate, if I'm not mistaken. So your costs will go up as well. So I think it's really important for you to start diversifying your currency, your portfolio into multi-currency market. Okay. So, but next question we have in mind, is Singapore a safe market to invest? Right. So before I move into the industry to look at, please allow me to share screen to another part, which is the Chrome slide. Okay. So if you can see, can you say, type in a 1 if you can see the screen? Okay, type in 1 if you can see the Google Chrome share. Okay, Jasmine. Okay, thank you everyone. So unfortunately on trading view, they only show the STI, where the rest of it is ETF. So I think it will be better if I show you the board of indexes that Singapore Exchange have, where most of the people, now this is something extra, but I would like to share a bit. Most of the people, when they refer to a country's performance, they will refer to the key index, where STI, the top 30, and FBMCKLI, again, the top 30. But for me, personally, I would look at all shares, because it technically reflects the market as a whole instead of a particularly basket of stocks. So you can actually understand how well the market performed instead of just looking at the one simple index. For example, if you take STI, okay, if you take STI, actually the performance is quite the same, but if you look into FBMKLCI, which we'll be going into shortly, you can see the difference between small cap FBMKLCI and also FBM EMAS, right? But let's talk a bit about the volatility. Now in ST All Share, FTSE ST All Shares Index, you can see that there's a very steep rebound in terms of the performance. And even if year to date, I think the performance is quite good, where you can see 792 and we are at 771. That's a lot of movement in between. But if you look at the boundary that moved in between, it's between 800 plus minus to 700. But when we look at the NASDAQ, the three core indexes that presented in the US market, where we have Dow Jones 30, we have S&P 500, we have NASDAQ. So you can see that in terms of year to date, the movement has been quite drastic. Okay, so this is year to date statistics, where the STI, the Singapore market, they actually perform quite stable in that sense. In terms of year to date, I think if we look at 1 year, it will be more drastic. Okay, before in terms of NASDAQ, due to the fear of slowdown in terms of growth. Okay, S&P and Dow Jones 30. So the volatility is there in terms of US market. Of course, if you are a option trader, it will be more fun for you to be in the US market. But if you are looking for safe haven to diversify your portfolio of assets, then I think the relatively stable Singapore market is one of the better choice for you, especially if you're Malaysian, you have somewhere to diversify your currency as well. So interestingly, let's look at the FBMKL index. Okay, so if you look over here, that FBMKLCI actually performed quite in tandem with FBM EMAS and SCAP this time. But over this period, actually the difference is quite drastic previously. But now, I think our foreign fund exposure, we are back to 20 to 21%, where the total market capitalization of the whole Malaysia market, in terms of the foreign exposure, we are at 20 to 21%. So as compared to 1 or 2 years before, obviously that had decreased. Once again, due to several factors that we mentioned before, there's a issue on the political, and also the weakening currency, as well as the OPI is not going as aggressive as the the Federal Reserve rate. So if you're coming from a international investor point of view, would you rather invest in a bond that is issued by US, going at the same interest rate as compared to Malaysia? So definitely you have the answer when the interest rate has gone up, where OPI is stagnant. So OPI stagnant is not to say it's something bad, but comparatively in terms of investor point of view, we might see some outflow in terms of fund. So this is what we are observing in terms of Bursa Malaysia. But hopefully, after we have a stable government, everything will be better, right? Actually, this is supposed to be. Actually, we shouldn't take BTC and ETH, but for some of the young investor out there that are interested in the cryptocurrency, so you might have to be more careful now due to the FTX has gone burst. There's another platform that gone burst. I forget about the name, but what I'm more worried is the chain effect that's going to impact the tier 2 or even tier 1 currencies that you have. So if your portfolio of assets is mainly in cryptocurrency, so I would, I'm not a licensed advisor, so I couldn't give you advice, but coming from personal experience, it's better that you could diversify some of the assets into a safer investment, right? Okay, now this is the currency price movement chart that we had mentioned just now. So obviously with the aggressive basis point increase that we mentioned just now by Federal Reserve, you can see the USD against the safe haven, another safe haven currency, JPY, Japanese yen. It went up quite substantially, 22.58% on year-to-date basis. But Singapore, if you look at their interest rate increase, they are not as steep. They're not as steep, but they are actually powering up against the USD. The difference is actually not that far away between the two. So if you look at ringgit, obviously, well, when compared to Sing dollar and USD against Japanese yen, obviously we do not have the edge. So again, diversifying into Singapore exchange, even if you get the same rate of return, for example, if you put in a stock that generates, let's say 10% yield per annum in terms of capital gain plus the dividend, when you have the assets that gain the forex gain for relatively low risk, for example, in Singapore, then I think it's quite interesting to see how your portfolio will go in a long term when it compound. Okay, so during this time when I remember when I just started sharing, I talked a bit about when if you have not invested in the stock market yet, now is a good time for you to start looking into stock market, and you could diversify into the other countries' asset without having to cash out from your existing shares. For example, in Malaysia, that you might suffer some capital loss if you buy at the beginning of the year or you bought some shares last year. So it might impact your return. And also when you convert, the cost might be higher at the juncture. Okay. So now back to the slide sharing that we have just now. Okay, so I've given away what are the industry that we are going to look at in the Singapore market, but I'm sure that Singapore is well known for two industry that everyone is actually aware of it. First one is the bank. Singapore, I think they are one of the strongest financial hub in terms of Asia region. Even if we look at international level, they're still quite strong. And also REIT. This is actually Bukit Jalil. Of course, this is in Malaysia. This is something to get you familiarized. It's not really representation of the Singapore market, but we'll talk a bit about a couple of stocks and also some example in terms of performance of the stocks in Singapore, right? I will also share how you could briefly study on the Singapore shares as well, coming from a Malaysian investor point of view. Okay, so I'm going back to the Google.com. Okay, so so we are looking at the Bursa Malaysia Finance Index. Again, this is year-to-date comparative basis where we have plus 4.3%. Previously, prior to the election and also a further steeper and political and also global diversity, I think we are performing quite well, close to 9%. But as you know, when Malaysia we have the election happen, naturally fund will move out and they would first observe. Interestingly, local funds in Malaysia are one of the biggest outflow in terms of the investment in various industries instead of foreign fund. So this is a bonus to share, but I think once we have a stable government, you might see a lot of fund, they will be rushing back to regain their equity position probably by end of December. We also have the window dressing effect coming on. Okay, but that is on Malaysia. Now, looking at if you have invested at the start of this year until today into DBS Bank, OCBC, and also UOB. So the three of the stock actually perform relatively quite well, as you can see over here. DBS especially, it's going up on plus 12.08%, as we can see here. So you might wonder also on the valuation of these shares. Actually, the valuation, I did a bit of checking this now. DBS PE valuation is 13.77 times with a 4% dividend yield. And if you add it up by now, probably you would get a close to 16% return. And we also have the OCBC with 11.59 times PE with 4.51% dividend yield. UOB, now UOB, a lot of people, they might think that they just taken over Citibank. So surprisingly, the UOB, the PE is at 10.78 and 6.38% dividend yield. Now, of course, the valuation is not only the factors that we should look at when we are looking into financial stocks. There are also other factors that we need to talk a bit about later on, which is the NIM, NPL, and also the loan portfolio. Now, if you are into finance stocks, or if you invested into some of the stocks in Malaysia, Maybank, Probank, Holland Bank, probably, then you might have already aware of the acronyms. But if you're not, don't worry, we'll go through it one by one later on. Okay, so compared with some of the larger banks that we see in Malaysia, actually we're seeing Maybank 12.69 times PE, but Maybank, surprisingly, we have a very good dividend yield, 6.78%. But again, if you were to factor in the exchange rate as well, the return will be very, very different. Okay, then we have Private Bank, one of the best loan portfolio bank that you can get in Malaysia, 14.95 times PE, and also 3.55 times dividend, 3.55% dividend yield. Then we also have another very safe bank that you could see in Malaysia, very conservative bank, Holland Bank, 13.5 times PE ratio and 2.69% dividend yield. Okay, so if you compare the dividend yield, obviously the Singapore one, they are more generous in terms of giving dividend. And DBS Bank, I think in fact their latest analyst call, they had mentioned that they would be giving out more dividend to come. So if you have DBS investors, so you could look at more dividend going forward. Okay, so to be honest, we do not see a huge valuation gap in between Singapore banks and Malaysia banks. But if you compare the index and the performance of the three case study we have taken out, you might see there's a difference here already in terms of 2022 year-to-date data, and also when you factor in the currency, the return is actually quite substantial going for long term. And another thing that I should note, that when you are investing in Singapore banks, they are talking about Asian regional financial hub. So that's another layer of premium that you should add to the valuation. Okay, so let's take a bit of study on the DBS. This is their financial result notes that they have shared. Let's talk a bit about NIM first. Okay, net interest margin. Okay, so this is the net interest margin of the group. You can see that it's actually increasing now. So what is NIM or net interest margin? Basically, net interest margin, if you take it literally, okay, basically you take the loan from the when you deposit into the bank, and when the bank actually borrows it out to other borrowers, so there's the interest gap in between. Of course, there are also other operating costs in between. For example, their headcount, the bonuses they are giving out to people who put in the FD, but that's all factored in. So we have the NIM over here. So that's the spread that the bank is earning. So obviously, the larger the spread the bank have, it's better for them. But at the same time, you also need to look at the loan portfolio of the bank. How many percent of them are, for example, how many of the loan is in fixed, and how many percent of the loan is in variable? So you actually have to look at that. For example, if a consumer bank, they have more exposure in terms of the property, the increasing interest rate is actually beneficial for them, because the interest or NIM they would have will be higher going forward. But at the same time, you also need to have a look at the country's risk. What do I mean by country's risk? When you look at Malaysia, when OPR goes up too high, obviously there will be a lot of bankruptcy going forward due to the fail of repayment, or whether it's AKPK or whatsoever. It will impact the NPL ratio, non-performance loan, which means that the bank couldn't collect the loan back in terms of principal NPL performance. So the NPL performance in Malaysia, I think it's 1.9, best if 1.9 plus minus. So you have to have a look on the NPL performance. But in terms of DBS NPL, I think they're doing quite well. NPL currently they are doing at, okay, one moment guys. Okay, so NPL they actually improved to 1.2%. So it's quite low given how large the size of the largest bank in Singapore. Given their size, the NPL of 1.2%, you can see how prudent they are in terms of their asset management. So this is a really interesting company for us to have a look at when you are talking about the financial sector to look into. Okay, then we also have the OCBC Bank. Let's also look at the NIM. Okay. Let me see if I can find the number. Okay, I think they do not have the NIM in this slide particularly, but okay, wait. Okay, it was here. So NIM for the OCBC Bank, it is higher, but OCBC Bank actually if you know them in Malaysia, basically sometimes their risk exposure is normally higher. So let's look at the NPL as well. So okay, interestingly for OCBC Group as a whole, you can see the NPL is actually at 1.2%. It's on par with DBS just now. So looking back at the valuation, DBS is set 13.77 times, 4.07% dividend yield, and OCBC is trading at 11.59 times PE ratio, maybe 4.51% dividend yield. So in terms of absolute valuation wise, OCBC, they are cheaper as compared to DBS. But let's take a look at UOB as well. Okay, NIM for UOB, it's 1.95%. And let's look at the NPL for UOB. Okay, UOB, if I'm not mistaken, they are higher in terms of NPL. So NPL for UOB, although it's improving from quarter-on-quarter basis, 1.7% to 1.5%. But generally speaking, the valuation for UOB here is actually cheapest, 10.78 PER and 6.38% dividend yield. So it's quite interesting to see which company that you are actually going to invest to. Okay, so maybe if we have the time, we can talk a bit about selecting the share. Now, personally, for me, if you could buy, I always have this comparison. I'm not naming the companies, but if you could buy a BMW, a Toyota, and also a Proton at the same valuation, so obviously you will go for the BMW naturally, the one with the highest performance, most stable performance. You are talking about a safe haven for your asset now, the most stable performance, the most consistent performance. And DBS, I think their dividend yield is most likely going to go up because they have a major something like allowance. I'm not technical enough to explain the term, but they have something called the allowance that once it's gone, when the market is more I wouldn't say safe, a more stable market, then we would see that DBS probably they give out more dividend by then. So you can have a look at DBS going forward. Now, another interesting sector that we will see is the REIT sector. Now, if you're Malaysian, then we have a 10% withholding tax in terms of your distribution that you get from Malaysia REIT. That is automatically deducted when you receive the distribution. You will see that that's a taxable and non-taxable distribution. But for Malaysian investors towards Singapore REIT, generally the withholding tax is actually gone. It's effectively tax-free when you invest in Singapore REITs. So I've selected 3 more interesting ones. There are a lot of REITs in Singapore. In fact, I think they are the largest in terms of AUM around the region for REITs. Okay, so you can look at REITs. Interestingly, we talk about how interest rate could affect the bank earnings, provided their loan that given out and also their cost of fund, which means their CASA account, the fixed deposit that they receive, the way they gather the fund. Now, as for REITs, we are seeing a different scenario for the Singapore market. In Malaysia, surprisingly, we're seeing very, very stable performance across the whole REIT index. Okay, but in Singapore market, we are seeing a more steep downwards performance in terms of the REIT performance on a year-to-date basis. So could this be an opportunity for you to invest in? We'll find out more later on. Okay, so let's talk a bit about yield. When we're talking about REITs, generally we're talking about yield. We are not too much towards the capital gain, to be honest. Malaysia REIT, this is gathered from the statistics online. Malaysia average yield is approximately 6.75% of financial year 2022, based on the Bloomberg forecast. And our MGS, our bond, 10-year bond is around 4.41% yield. FD rate based on Maybank is 3.1%, EPF is 6.1%. EPF, it might fluctuate a bit, given how there's a shift in terms of their portfolio recently. And the OPR currently is around 2%, 1% plus minus. So with all these factors, so you could see that when you invest in Singapore REIT, you might question on what is the yield that I would get. In terms of Singapore REIT, in July 2022, the SG rate average return, average yield is 6.3%. So if you add on to the currency, obviously you get a quite a good return. I think that's close to 10%. But unfortunately, if you invested early of the year, you might lose out in terms of capital gain over here. So let's have a brief study on to this couple of REITs before we move to the Q&A. Okay, so one of the interesting one that I would like to talk about is the industrial REIT. Now, normally I would avoid office REIT now because after the COVID-19, I'm sure those who are working in the office, you will notice that there's a trend where there's 3 days you work in the office and 2 days you can go home and work from home. So for the company itself, it costs them lower resources. For you itself, it costs you the lower travel time, lower expenses as well. Most importantly, some of the companies, they are actually utilizing this as one of their ESG initiative as to they are calculating the carbon emission from you traveling from your house to the office. So I'm afraid that the office REIT demand, we might see some decrease, especially for I would say grade B onwards properties, but for prime grade and also grade A office properties, probably we see the big names, they will still occupy the space regardless. Okay, so for Mapletree Industrial REIT, you can see that the DPU, the distribution per unit, is quite stable, stably growing. And you can have a look over their portfolio over here. The AUM is quite substantial. Actually, it has grown quite fair bit over here. Now, how do you want to actually understand a REIT profile, whether they have a growth potential or not? First of all, you have to look at who are their sponsor and what is the asset they are going to acquire going forward. Now, once they acquire, or during the time they are going to acquire, normally they will go for fundraising. Okay, so in terms of fundraising, we are talking about in terms of fundraising, we are talking about either you go for debt financing or you go for equity. Normally, equity, you will have a dilution in terms of your per share basis or per unit basis. And if they go for a financial loan or sukuk fundraising, then it will impact the gearing ratio of the REIT itself. Okay, so whenever a REIT, it's when they're talking about acquiring asset, etc., all you need to do, you need to look at whether the acquisition it will effectively increase their rate of return or not. Okay, if it would increase the distribution per unit. Now, the tricky part again, per unit, we are not talking about net distribution income, because when you diluted your per unit basis, an increase in distributable income might not cover up the dilution. So it's always good to look at the DPU or look at the yield directly after or before their in their proposal during their acquisition. And I think the track record of a REIT acquiring assets actually serves as a very good guideline for you to study whether this REIT is wise in terms of acquiring asset, or their sponsor are utilizing the REIT vehicle to just cash out on some of their not so well performing assets. So there are some sponsors that are doing that, obviously. I do not want to name them. So you can look at the past performance of a REIT that after they acquire, I think the result says it all. Okay. So now we talk a bit about AEI. If you are in the looking into retail REIT, AEI is especially important. Most of there are not too much pure play retail Singapore REITs that are listed. A lot of them, they have a set exposure, some in Indonesia and some in other Asia regions. So it's important to look at whether how much they're investing per year into the AEI, as in how much they're investing to furnish up their property in order to attract more footfall. Now, footfall normally it would equivalent to higher purchase. When you have a higher footfall, you have a higher conversion rate, it's easier for you to attract quality tenants. So it's actually a positive reinforcement cycle. When you have a quality asset, one or two that comes in, naturally you will attract more quality tenant along the way. So when you have quality tenant, again, it's a qualitative factor. When we when we're trying to quantify the qualitative factor, it will effectively convert into RR, triple R, the rental revision rate. So it basically means that this year I'm charging you 10 Sing dollar per square foot. So next year, how many percent can I increase? Can I increase 3%, 5%? Now, the increase in terms of the RR, normally it will convert directly into the growth of the REIT. So if you are seeing a positive RR, is always a good sign for the company, unless otherwise the tenancy, the take-up rate of the property is dropping. Then the REIT, obviously the manager is not doing a good job. You're increasing the your prices on your property, but you're not attracting more tenants. So that's actually a red flag for you to look into this kind of REIT. Okay, so okay, I think one more thing that's attractive about Singapore REITs is that normally they would have a very comprehensive presentation slide on their website, as you can see here for Mapletree Industrial. You can see that since their commencement, how many assets, what are the track record of assets that have acquired, and many more data. Same goes for Keppel DC REIT. Now, Keppel DC REIT has been one of the favorite REIT Malaysian is looking at, because when we talk about future, it's always about data center. But when we try to value a REIT, normally we will value based on, we normally don't use PE, by the way. We normally use the NTA, price to book value, PTBV. 1-to-1 is optimal, provided the company have a quality asset. What does that mean? So for example, if you are buying the IGB REIT in Malaysia, okay, so if you are, the NTA is 1.5, you are paying 1.5 in terms of share price. So you are paying a fair value to acquiring the quality assets under IGB REIT, which is the Mid Valley Mega Mall, and also the Gardens Mall. So when you see a 1-to-1 PTBV, always go and check out whether the assets are quality. Normally, the REITs that have really quality, what we call properties, they would have a premium over their valuation. So we don't always get a bargain, especially for Keppel DC REIT. For a very long time, I think Keppel DC REIT, they are enjoying a premium due to their nature being a data center, which when we talk about data consumption now and data storage, the demand is actually still growing despite we're seeing slowdown in terms of the memory segment. If you're into technology sector, I'm sure you heard of the memory DRAM, the prices are dropping, the demand are dropping. But data center, in fact, the organic growth, I think, is still there for Keppel DC REIT. But obviously, Keppel DC REIT, the share price had went down quite substantially here. I need to check back the quote. Unfortunately, they don't have a shortcut. It's alpha numeric. But anyway, it had dropped quite substantially. But I think Keppel DC REIT is quite stable in terms of their portfolio. So it's a really interesting REIT for you to look at, especially when people are concerned about the interest rate hike. Now, another interesting thing that you should look into when you're looking into REIT, when you look into their debt profile, always try to study their debt profile. Are they fixed or are they variable? It's same like a person. When you are assessing your own finance, you want to know how many percent of my loan, my car loan most likely is in higher purchase, so the interest rate is fixed. But my property or my credit card loan, it could be flexible. It depends on when you sign off the contract, what are the terms. So as for the REIT, it is the same. They have the high number of flexible interest rate portfolio, and they have no plans of going to refinance it anytime soon. So probably they might face an increase in terms of financing costs going forward, especially when their loan currency is denominated not in terms of home currency. There's an additional layer of a forex exposure to it. So you have to be really careful. And there's also a weighted average. Okay, here's the cost of debt. Okay, cost of debt. They also sometimes they have the weighted average, the loan expiry, the debt expiry in their presentation slide. I think Capital DC would have as well, but we have to look for it a bit. Okay, so you can for example here you can see that 76% of their debt is fixed and 24% is floating rate. Now that's quite good, and you can see that the debt currency breakdown over here. So you can roughly gauge what is the forex exposure that they would facing. So GBP, EUR, AUD, I think these fields are still okay as compared to how the US perform. And then obviously we have Ascenders REIT, which they also have very interesting portfolio of assets that maybe you can discuss later on. As you can see here, they have a very high occupancy rate. Talking about occupancy rate, generally I will look for companies that have 90% and above occupancy rate. Some with triple net lease, basically it means that whatever the tenant pays you is basically net. It covers your utilities as well and also tax sometimes. So those type of properties, naturally they have a 100% rent out rate because it's a master lease agreement. And this kind of properties is interesting because you need to see what is the step up condition. When they have 100% occupancy rate, sometimes it will also mean that the REIT couldn't grow because they already lock in the 100% lettable area that they have to a single client. If the terms has mentioned that within 5 years, you could not increase my rental rate. So it means for the 5 years, unless they're acquiring new assets, there could be no growth coming from the REIT itself. So you have to be careful, even though you see 100% occupancy rate when you see looking at a REIT. But generally speaking, when we factor in the currency factor, it's always good to have some of the Singapore stocks, especially in the finance and REIT sector. That's what SGX is most well known for. These two are the most attractive sector that you can look at currently, especially with REITs. I think they are quite beaten down because of the not higher than expected results performance, and of course also the concern over rising interest rate impact on them. But as you can see on Capital DC REIT just now, their debt portfolio is quite healthy, to say. Okay, we can see quite a number of questions here, so maybe I'll pass it back to the host. We can take a couple of questions.
Yeah, thank you, Max, for sharing with us today. Let me just share my screen. Okay, before we go into the Q&A, I would like to thank you all for tuning into the session today. We will be starting the Q&A session very soon, so if you have any further questions or inquiries, feel free to type them out in the chat box. And so if you want to know more about trading in Singapore, do scan the QR code here or visit the link to know more. And you can also join the SGX Invest Telegram channel to get the latest market insight in Singapore. So again, scan the QR code to learn more about or join the Telegram channel. To enjoy free access to MQ Trader services, you can open a trading account with M Equities LIH team. The free access service systems that we have includes MQ E-Trade, Analysis Tool, MQ Point Accumulation, MQ Affiliate Program, and many, many more. So if you're interested, do sign up now. And what's more is we are having a cashback campaign, 100 ringgit cashback for all who open a trading account with them. And when you buy you have 3 buy transactions in the Singapore market. So if you're interested, again, you can type 3 in the chat box or scan the QR code to submit your contact details, and the respective team will contact you shortly. Okay, for MQ members, remember to submit your screenshot in a post-webinar quiz so that you can get your bonus 300 MQ points check-in rewards. And if you haven't taken the screenshot, you can take it now. And if you haven't registered for this webinar, you can do so now because you will need to be able to receive the quiz and also every post-webinar updates if you want to submit or you want to get the check-in bonus. So do register now if you haven't registered. And after the Q&A, we will be having our mysterious gift session. So do stay tuned for it. There are gifts worth up to 249 ringgit waiting for you to win. We will start the Q&A session now. Max, let me check the questions. I believe there are a few questions, but due to time constraint, we will choose a few, about 3 to 5 to answer during this webinar. So the first question is from Ong SS. He or she asks, recession normally hits the financial market first. So wouldn't it be risky to buy bank now? Because given that the risk of recession in near future is quite high.
Yep. I think the recession is already here, just that okay, this recession is actually quite different from previous that we have experienced. Previously, we just experienced a huge demand going off, but last time the market has been flooded with so much cash that there are still some left over now, and we are slowly seeing that the demand is slowing down. Now, if you're into US market as well, you can have a look at the consumer companies, for example, like Walmart. You can look at their performance over time. I think they are not going to show growth, and especially if you want to observe the recession indicator, you can look into the Q4 calendar year basis, Q4 financial performance for the retail companies. So for example, like Walmart again, one of the very good example, with Black Friday and also Christmas just I think a few weeks away. So even that couldn't boost the growth on the year-on-year or quarter-on-quarter basis, then you know the recession is here. So yes, the recession really hit the financial market. I believe the financial market has already got hit, just not to the extent that it will happen in a crash. To be honest, again, this is a quick disclaimer. This is not my prediction, just what my hunch that even though there is a crash, it will not be a drastic crash like 2020. Most probably it will be a slow and even drop in terms of the prices of multiple asset classes. So when you are seeing drop and you want to protect your return, one of the things that you can protect your return if you were to allocate your capital now, you want to allocate your capital into a industry that is getting hit lesser. So now interest rate is going up. So one of the industry that has the higher confidence level that they could grow, even though in a recession. Now, in terms of loan growth, I believe they will drop a bit, but the NIM, net interest margin will even out a bit. So if you compare putting the money into manufacturing sector, energy sector, maybe into plantation sector, as well as the banking sector basically it warrants a better return for the next 2 years. And also, if you're talking about the risk of default in terms of the borrowings, I think the bank, they generally have the lowest risk amongst all the subsector that we mentioned, even including tech, which highly leveraged tech companies, they might face a higher financing cost as well, where bank itself, they are the one to, they churn out the money and they collect higher interest in that period. So that's what I would feel in investing in the financial sector for now. And also not to mention some of the banks in Singapore, they give quite decent dividend yield as compared to the local FD. I think it's less than 1.5% FD rate in Singapore market. So yeah, 4 to 6% is quite a good range that you can look into in terms of dividend, which we haven't had the effect of the currency exchange profit in between as well. So that's what I feel about the financial institution industry.
Okay, so just to clarify, the 4 to 6%, you mean even during this sort of recession time, you are expecting banks to have this 4 to 6% returns?
Okay, that's actually a very good question, because when the share price went down, your dividend yield would generally go higher. We are talking the 4 to 6% is based on the share price now. Assuming that the bank, they are able to sustain a stable level of earnings, and if the Basel III requirement, they don't require banks to have more reserve, then I believe they would have, even if maintains at the same level of dividend payout, when the share price go lower and you go into the company at a lower share price, effectively your dividend yield will be even higher at that juncture. So yeah, I think it's a very interesting point to point out. 4 to 6% to clarify, yes, it is based on now.
Okay. Yeah, thank you for your answer. So the next question is about REITs. So as REITs are leveraged in investment instruments, isn't rising interest rate a bad news for REITs?
Yep, agree. But I don't think they are too much. I think they are not a pure play leverage product, because some of them actually have a quite low gearing of maybe we're talking about 20% and 30%. Rising interest rates is indeed not a good thing for REIT, because their cost of financing that they have currently is high. And we're talking about cost of financing going forward. If they want to acquire asset now, the cost of financing, it will also be higher, even though they go into a sukuk financing for now. So you have to look into the debt portfolio for the REIT currently. Okay, how many percent is in fixed and how many percent is in variable? If a lot of them is in variable, but the loan is going to expire in half year or another year, so we might be looking at a refinancing situation might change for the REIT itself. So you have to look at where the loan is actually based in. If it's based in Singapore, I don't think the rate increase would be that steep. But generally speaking, I've talked to quite a few of REIT in Malaysia, REIT companies in Malaysia. If you're converting your variable financing facilities into fixed one, the spread is going to be between at least 125 to 150 now. Previously, it was 100. So what does that mean? If you have a variable loan that is charging you 5% interest previously, now they're going to convert, once they convert into a fixed one, extend the period, let's say for another 5 years, the fixed interest rate is going to be 6.25% onwards. So yes, it will increase the interest rate for them, but at the same time, in a more challenging environment, it will be better for them to get better deals. So it comes down to the track record of the REIT manager to hunt a good bargain. So as I mentioned just now, you have to look at their track record, how they acquire the asset, and net effect. Do they increase the DPU for you? What's in it for you as a REIT investor? If the DPU has been has been growing consistently, if you have the data back in 2008, it will be best, because you can see how they perform during the financial crisis. So you have to look at the holistic view of it. And as you mentioned, REIT, a lot of people, they are not too positive against REIT currently. So now perhaps the depressed valuation, if you're looking at 3 to 5 year investment horizon, so probably you can look into positioning yourself more comfortably, as long as the asset are safe and also their debt portfolio is not outrageous. I think it's quite interesting to look at that.
So it's not a straightforward answer. You have to look at a few factors and combine them to value.
Yeah, unfortunately for REITs, I don't have a straightforward formula, because the type of assets they have are different. The occupancy rate is different. Their DPU payout track record is different. The manager is different. The weighted average debt portfolio, again, is all different. So you have to look into them very specifically on each of them.
So in general rules of thumbs, how much floating rate would be good and how much fixed rate would be good in rising interest rate environment?
I think you can track at 2021 data, and you can compare their financing cost now. You can see what is the increase. If the growth is outshining the growth of financing cost is outshining their organic growth, then definitely there are something wrong with the REIT. But if it's a reasonable slowdown in terms of growth, again, in terms of 3 to 5 years financing investment horizon, you can look into it, because eventually when the period pass over and once they refinance the debt, and I think 3 years or 2.5 years, it will be the tipping point where the DPU step up again for the investor once they fix the rate, and also their assets start to show growth that generate better returns for the investor.
So now maybe floating rate would be good for short term.
If they have a floating rate, okay, not to say floating rate is bad. I think fixed rate with a longer expiry is better. And floating rate, it depends on what is the expiry. If it's close to expiry, then I think it's better because they are forced to renew the loan eventually. So most likely they are going into fixed in terms of the manager point of view because they don't want to face with uncertainty. But honestly speaking, I doubt there will be very steep interest rate hike going forward in the Singapore market. Even though for US, we are seeing a less hawkish stand in terms of interest rate increase going forward. So we'll see about that.
Okay, thank you very much for clearing the air. So the next question is from Chen WC. He is asking, when trading the Singapore's bank stock, how can we protect ourselves for potential recession? Recession topic again.
Okay, I think when the recession hit, generally whatever market that you invest in, it would get hit unless you are in very safe debts, bonds. Okay, then you might get a positive return in that period. But if you're talking about equity, which includes REIT, whichever market you would invest in, you will get hit eventually. So it's better for us to look into safer, what we call the safer countries for us to invest into. Now, Malaysia is, we are not saying that it is a political speaking wise, and also unfortunately foreign exchange currency standard point of view speaking wise, I think to diversify some of the asset in the Singapore market, it will be wise in terms of asset allocation. So you can look back into the performance of some of the bank stock in Singapore during the recession, and then you can compare against the performance of share price performance of the major bank in Malaysia. So you can see which of the market it will drop in a steeper condition. And when we are seeing that kind of environment, another thing you have to factor in is the local default rate in terms of the loan. If you're talking about loan in Singapore with their stable currency, and also generally I think the standard of living and are quite high, except for Malaysian going to Singapore to work. Generally, if a skilled person in Singapore, I think their earnings and their risk of default is quite low as compared to Malaysian side. Malaysian side, I think a lot of Malaysian, we are highly leveraged due to the cultural difference. So when you look into the portfolio of consumer loan, then when recession hits, then you can actually see the impact in terms of the impairment and also NPL that will come up. But as I mentioned just now, I think the recession is already here, just that we are not feeling the full impact just yet.
Okay, so again, have to take note on the NPL and all the income statements and all that. Yeah. So last question, I'll combine two questions to one. I think we have answered it in the chat box, but I think you can clarify it when you're saying. So Grace from Facebook and also Mel is asking, how can we trade in the Singapore market? And also, how can we buy REITs in the Singapore market?
Okay, I think I'll leave it to the host for this one. They are the expert in terms of introducing and onboarding you for the process. But okay, coming from a Malaysian point of view, I would advise you to get a cheaper broker for you to invest, because your cost of investing is lower, obviously. But also remember to check on how would they treat your dividend payment. What is the cost for them to handle your dividend payment? Because some of the IVs, they might have cost in terms of handling your distribution payment from Singapore, and you need to figure out the cost, especially if your capital is not huge. Then the baseline cost for handling the dividend, it might eat out your net return. So you have to clarify on that. Yeah, but onboarding process, I think I'll pass back to the host.
Okay, sure. So back to the question would be to open a trading account with our M Equities LH team. Thank you, Max, for the insightful session. And thank you once again for all who tuned in today. So that's all for our Q&A session today. And I believe, thank you, Max. I believe all our viewers have learned a lot from you as well.
Yep. Thank you for having me, and enjoy the mystery gift session going forward.
Thank you. So back to the question just now. To all our viewers, if you're interested in opening a trading account or getting the cash back 100 ringgit cash back. So remember to sign up now, submit your contact details through the QR code or the link, or even type 3 in the chat box and the respective team will contact you shortly. So just a heads up once again, we have released our MQ Trader calendar for year 2023 in our marketplace. Remember to redeem it, okay? Because it's a hot selling item always. Previously, it's gone within few weeks. So if you're interested, do place your order as soon as possible. You can save this screen, screenshot it, save the QR code so that you can place the order after that, after this event. And good news for those who are in JB, we are finally having our physical workshop. And the first station will be in Johor Bahru. Registration is free. It's on the next Thursday, 1st of December. And this is a 2 hours workshop where we will be sharing 2 different insightful topics presented from our MQ Trader team and also a guest speaker from Verse Capital. The seats are limited due to room constraint and space constraint. So do scan the QR code here to register as soon as possible if you are in JB. And we'll be starting our mysterious gifts session now. Remember that you can win gifts worth up to 249 ringgit. And I will show the questions just to run through how it goes in case anyone don't know. So I will show the question and also answer options on the screen. You just need to type out the correct answer as fast as possible. So for each question, we will choose 1 winner from Zoom and 1 winner from Facebook. So if you have won before, we'll pass the chance to the next person so that everyone gets a chance. And for winners, please send us your contact details through the Google form so that we can arrange the gifts for you. So I'll just give you guys a few seconds to start, to get ready your keyboards and all that. Okay, so I believe everyone is ready. All right, so we are having it in Zoom and also in Facebook. Okay, the first question. How much cash back can you win when you open a trading account with M Equities LRH team and invest in Singapore market? You can just type ABCD, that is faster. Okay, so the answer is D. Wan Zulkarnain, you are the first one, but not the correct answer. Okay, CH Tan, you got it correct. RM 100. Let our backstage, yeah. So congratulations. The winner for the first session is CH Tan in Zoom. And let me check in Facebook. Facebook, the first winner would be Su Wen. Just give us some time because you guys are answering very fast. Okay, so ready? We are going to have 3 questions. Here's the second question. Yok Long, I even haven't shown the second question, how you can answer. Okay, the second question. Which events below have caused market uncertainty recently? A, B, C, or D? Okay, this time Wan Zulkarnain got it correct. B, political uncertainty. Okay, due to a lot of deglobalization, the war, even our GE15. It's kind of a tricky question. Let me check on Facebook. On Facebook is Buoyed. Congratulations to all our winners. Remember to use the Google form to submit your details. Okay, get ready. We have the last question where you can earn your gifts. Ready? Last one. Which SGX counter was mentioned by Max today? So the first to answer correct from Zoom is, oh wait, the answer is DBS, bank sectors. The others are not the bank sectors, so it's quite an obvious answer. So from Facebook, we have INET as the winner. So all our winners, remember to use the Google form to submit your contact details so that we can arrange the gifts for you. Let us give them a few seconds for them to submit their details. Okay, so I just repeat the names. The first is CH Tan. Second is Wan Zulkarnain. Third is Yu Long Liu. This is from Facebook. And for Zoom, it would be Suwen, Aboy Loy, and also INET. Okay, remember to use the Google form to submit your details so that we can arrange the gifts. Okay, so while waiting for them to submit their details, remember, for MQ members, remember to submit your screenshot in the post-webinar quiz that will be sent to your email after this so that you can get your bonus 300 MQ points check-in rewards. And if you haven't taken a screenshot, remember to take it now in case you forget after that. We are ending a while later. Okay, so if you haven't registered and you want to get our post-webinar updates, including the quiz and also our webinar recordings, remember to register now. You can scan the QR code to register straight away. Okay, so, and good news once again, for all who are in JB or who can travel to JB, we are having our physical workshop next Thursday on the 1st of December. It's a 2 hours workshop and we will be sharing about 2 different topics by our MQ team and also guest speaker from Verse Capital. Seats are limited, so do register as soon as possible in case you miss out the tickets. And our MQ calendar for year 2023 is out now. So remember to redeem it at our marketplace as soon as possible as well, because it's a hot selling item. You can scan the QR code or save this screenshot for later reference. And then Equities, our H team is having this 100 ringgit cashback campaign. If you're interested in getting the 100 ringgit cashback, type 3 in the chat box or submit your contact details by scanning the QR code here, and the respective team will contact you shortly after this. Let me just double confirm all our winners to check if they have submitted all the details. So if you have any questions regarding MQ Trader, do feel free to send them in as well. I'll try to answer. And regarding the mail questions regarding the how you buy REITs, right? You can buy straight away on the Singapore stock market as long as you open a trading account that allows you to trade in the stock market in Singapore. And one of the account is with M Equities, our H team. So if you are interested to trade in Singapore market, do check this link out. Do check out this trading account. Then you can just buy as usual, buy and trade as usual. Okay, so I'm just trying to double confirm if every winner have sent in their details. So far, we have 3 sent in already. Let me just check. Oh, 5, sorry. So we are waiting for Liu Yuk Long. Liu Yuk Long, remember to send in your contact details using the Google form. You can find the Google form on the chat box. If we end this webinar without the forms, meaning that we will be forfeited because we can't contact you after that. Okay, so remember to use the Google form to submit your contact details. And once again, a very big thank you to all of you who have participated in our webinar today and made it a successful one. MQ Trader will be organizing webinars at least once every month. So remember to follow and like us on our Facebook and Instagram so that you won't miss any of our updates. You can find us on Facebook and Instagram by typing MQ Trader and remember this logo, and you'll be able to find our account. You can also like and follow us on Insta, i3 Investor, and also our MQ chat so that you can get our latest updates there as well. And once again, if there are no further inquiries, we'll end this webinar today. Thank you for staying through and hope you have learned something today. I wish you all the best in your trading journey. And I will off my camera now. The webinar will be live for a few more minutes so that all of you can refer to the links in the chat box before it is gone. If you need any reference, you can always check it back in the chat box. So once again, thank you for participating in our webinar today. I'm Casey from MQ Trader, and I wish you a great week ahead. Bye-bye.
Thanks for watching.